everybody. This is Randy Wootton, CEO of Maxio, and your host of SaaS Expert Voices, where we bring the SaaS experts to you to talk about what's going on today and what they foresee for tomorrow. I am delighted to have one of the co-founders of SaaSOptics, which is one of the two companies that came together to make Maxio in 2021, Clayton Whitfield, who's originally from Savannah, Georgia, another Georgia boy, and has had a really interesting background. Started off as an engineer, tech guy, and then became one of the co-founders of SaaSOptics. We plan to talk about that journey, his origin story, what he's seen broadly in the office of the CFO, and then share some stories about what it means to be CEO. So thank you for joining us, Clayton. Really excited to have you here.
Appreciate it, Randy. Good to join you.
So let's back up. Let's, roll back down memory lane to the founding of SaaSOptics. Like, what was the idea? How did it come together? The motley crew that joined to take on this problem. What was the story?
So SaaSOptics, one of the cool things that I always liked about it is a direct outgrowth of our experience running our previous SaaS business. We had a previous SaaS business before, and in that business, we had kind of the same problems that a lot of people turned to SaaSOptics and now Maxio for. We had a bunch of disconnected tools, just Salesforce and QuickBooks and spreadsheets, gigantic spreadsheets and things like that. And so we had kind of all those problems running that business, and we knew there was a market out there for to kind of clean that up. And I'll also say one thing that we didn't get everything right, but we were pretty disciplined guys in that previous business, so we kind of got it mostly right with the spreadsheet and everything like that. But ultimately, it's just kind of the wrong tool for the job, right? When you're trying to run a SaaS business, get your revenues right, get your metrics right, and all that kind of stuff, especially a growing SaaS business. If you use all those disconnected tools, it puts a lot of pressure on the finance team and all those disconnected tools as you grow. And so we kind of knew that it's a metaphor that my wife is sick of hearing me use. It's kind of like driving a nail with a pair of pliers, right? It's just, you can do it. You can do it, but sooner or later it's going to fail, and you need the right tool for the job. So we knew the problem existed, so we decided to build the right tool for the job, and that's kind of how we ended up with SaaSOptics and on that journey.
That's great. I know my experience with SaaSOptics, what I tell people, was I was CEO of another company, Percolate. We were, call us in the 30 million-ish range, lots of customers. And I just remember, and this was my second time as CEO, but at both companies, the amount of time and energy our finance people spent to close the books, they would spend the first 8 to 10 business days trying to just close the books, get your GAAP financials. And then they would spend the rest of the month trying to figure out what just happened in terms of ARR and be able, gross retention, net retention by customer, by segment, by region, and try to make sense of it. And I tell people it felt like I was always sliding into the board meeting at the end of the month, hoping the numbers were right. And hoping that no one had, fat fingered a cell or deleted something so that the information was different than what we represented the previous quarter or the previous month. And then when we got SaaSOptics, it was like my life changed. And it went from not knowing anything until coming into the board meeting to having the information available literally on day one. Like when the month closed, all of a sudden you're able to say, okay, so where were we from an ARR perspective, and how did that play out in terms of loss, contraction, expansion, and new? Again, being able to break it down by customers, and it freed up an enormous amount of time for my finance team and allowed us to have productive strategic conversations throughout the month versus just trying to get it all ready for the board meeting.
Spot on. That's exactly right. I love the way you said that. Sliding into the board meeting with a handful of numbers you're not sure of is such a nerve-wracking. I'm preaching the choir here, but such a nerve-wracking feeling. And one of the things that I always really relished hearing over the years from prospects was, "Where were you guys when I had my first business?" Right?
That's right.
I used to love hearing that from founders, especially second-time founders, because they had the battle scars, and you've got them too. And so it's definitely one of the things that just never got old to hear that.
And I do think that's another thing. I'm a go-to-market guy, and so you come into companies and you want to tune the go-to-market tech stack, and so you're investing in marketing tech and sales tech and ad tech, and you're like, we're going to get more prospects and leads, and it makes a lot of sense, right? Because as an early stage founder, what you're trying to do is drive growth. But I think to your point around being a second-time founder is you recognize that you kind of have to balance the investments across front office tech and back office tech to bring it up to speed so that you're ready, especially if you have hopes to be invested with by VCs or PE professional money, or you're moving from cash accounting to accrual accounting, and you're going to need to be able to represent the ARR roll forward and the customer cohorts so that you can represent the business, because that's where they're going to spend all their time, is looking at those the ARR, which is representative of the contracts, and making sure that's accurate.
That's absolutely right, and that's one of the things that was always gratified too with SaaSoptics is the population that found us earliest in their evolution as a business were second time founders, because because they knew, to your point, they knew, yeah, you got to get the go to market right, but you also need to, you don't want to underinvest in the finance crowd and finance team and have them constantly playing catch up. And the finance team, it's stressful for them too, because if you underinvest in the finance team then can quite literally slow the business down, and nobody wants to be on that team. It's just
Right.
yeah.
Right. You're already a cost center. Yeah. You don't want to be a
Exactly
drag
right.
store, right? You don't want to be dragging things down. You want to make sure you're unlocking the value. Well, good. Well,
That's
maybe
right.
that's a great story. And again, like, congratulations on all your success. And so you were at SaaS Optics. When did it was founded in 2012? Is that right?
No, 2009. Yeah,
Excuse
like
me,
yeah,
2009.
yeah,
Okay. So
August 2009.
15 years.
Yes, exactly right.
Wow. What are some of your favorite memories in terms of inflection points of a
Ooh.
startup? You going through that journey, having a really super successful, you're relatively low invested in terms of how much capital was invested. 'Cause I think you brought that bootstrap mentality to it. But what are some of those inflection points or your best memories of the SaaS Optics journey?
So a couple that really stand out. One was, this is something you've probably heard me rattle on about before, but people get engaged intellectually in strategic stuff, but they write checks for operational stuff. In my
Hmm.
experience, right? So one of the things that would happen in the early days, the very 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 earliest iterations of the software, we only really did what as our software, as our subscription momentum report. We really just had that top table, opening balance, new upgrade, new upgrade, downgrade, and end of period balance, right? So that's really all we had. And we started pitching that to people, and they were like, "Yeah, it's cool, I love it, but guys, I do this like 4 times a year." Especially really early stage businesses, they might meet with their board, once a quarter, kind of stuff. And they're like, "I do this 4 times a year. I've already got a spreadsheet, guy. I really don't need this. I really don't need to pay what we were asking for at the time was really dirt cheap." But even then, they were like, nope, they couldn't really sort of get their heads around it because they did it a few times a year. But then we integrated invoicing, and kind of improved on the way QuickBooks did invoicing, for SaaS businesses specifically. We did SaaS invoicing. We did it really well, and once we did that, it changed the entire business. We started to grow because as you know, finance teams deal with invoices every single day. Somebody's looking at an invoice, whether trying to chase it down and get it paid, or it's an invoice from a vendor, something like that. In any case, invoices happen every single day in finance teams. Where we went from a product that was going to get touched 4 times a year to a product that was critical every single day, and that changed the entire trajectory of the business. That's one really cool memory. And the other one I would say is, this is more of a sort of origin story stuff. One day I was working on some cash projections, because as you know, you're obsessed about that, and especially because, like you said, we had very little money, so we're obsessed about cash projections. But we'd been closing some sales and everything like that, and I was working on some renewals. I was working on projecting some renewals, because that's you get projected cash. You got your cash in the bit, you cash on hand, got cash from new sales, and in SaaS, cash what you can expect from renewals, as you know. So I was working on a spreadsheet, right? Because that's all we really had at the time. So we had this junky old spreadsheet that was my baby, right? So I was working on it and projecting some renewals and all that, trying to cobble together a cash projection. And all of a sudden, I looked at it. I was like, over the next 6 months, we're going to have way more cash than I thought we would have, than was sort of expected. And for us, it was kind of a new sort of thing to have that much cash. So it's like, this can't be right. So I checked all my formulas. To your point, somebody fat finger something like that. I checked all my formulas twice and everything like that, and I was it still feels a little heavy on like we're going to have more cash than I thought. So I take the laptop to my co-founder's office. I'm like, dude, you got to see this. And so he looks at it, he double checks it and everything like that. So then we go to the worst deli in Atlanta and sit down with my laptop, and we just kind of showing it back and forth to each other and checking things. It was obvious that we're going to have more cash than we'd ever had before. And it was a new phase of the business. It was, to your point, is an inflection point. And we're like, all right, now we got to start hiring, because at the time it was just 3 of us smelly dudes in the business. It was still just the founders at that point. And so we were like, now we got to start hiring. So for the first time, we were able to start to bring people into the team and everything like that, and it changed everything in the business. It was fantastic. It's one of my favorite memories.
Well, that's great. I think that whole story around product market fit, and specifically for workflow applications, this distinction between the buyer and the user. I know I've been in that dynamic where at Percolate, we were content marketing platform, and you have the CMO. So this is great. I love seeing how marketing's laid out, and I can track all the campaigns and see how everything cascades. But what happened was that the user of the technology, the people that had to actually do the inputting, thought it was duplicative to the work that they were doing in their other systems and tools. And so that distinction between being able to create a tool that enables the users, the people on the front line, to be better, more efficient, and more effective, as well as having the not the secret sauce, but kind of the sexy sizzle of the Submo report that people use on the strategic level. Having both of those is the ringer, but where you're going to get paid for workflow automation is by making an operation more efficient and more effective, a daily operation more efficient, more effective.
Spot on. I love that. That's absolutely right. Yeah. I mean, yeah, everybody likes to look at sexy dashboards. That's just true. But they don't mean anything if the invoicing is wrong to begin with, or
That's right.
if your inputs are wrong, they just is useless.
So maybe that's a good segue into the second part of the conversation around this disruptions in the office of the CFO, or the evolution of the role of the CFO. When you were first at SaaSOptics, I imagine you were targeting other early stage SaaS companies. They probably didn't even have a CFO, or most of them using like Bob, their uncle, as their accountant, or how were they doing their finance? Those small companies that you were targeting, and then we'll talk about during the different their own inflection points of when they hire more seasoned and professional finance executives.
Yeah, I love that. That's exactly what was happening, especially especially with the first time founders. They're like, yeah, my aunt knows how to do QuickBooks, so they just pull in Aunt Jane, right? And so that would be, and that was their first finance person, right? And sometimes not even a finance hire. Sometimes it was part time, that kind of stuff. And often that person came from a more traditional business. Like we'd often run into people that used to do the books for a landscaping company, and now
Huh.
very, very few things. There's very little crossover between a landscaping company and a SaaS business, a B2B
Right.
SaaS business, right? On the finance side.
Right.
And so often they were out of their depth. So we often had some of our tech support people were better at SaaS finance than some of these brand new people that were brand new to the world of B2B SaaS. So that was how they were kind of doing it. They were kind of much like with their tools too. They were cobbling together people and tools, right?
Right.
So whoever they knew that could do a spreadsheet, whoever they knew that could do QuickBooks is kind of what who they would pull in. And then of course the market, as markets always do, started to evolve a little bit and get a little bit more mature. And then that's when I would say that sort of the early rise of outsourced CFO and CPA, fractional CFO and CPA, fractional CFO and accounting services. That cobbled together 5, 10 CPAs and some controllers and some CFOs and everything like that, and then sell that service to these smaller startups. And that's once that sort of took hold, then we started to see a little bit more maturity in the market in general, right? Because I don't have to hire Aunt Jane now, who doesn't really know SaaS, but I can go and pay this team of seasoned professionals that are all battle scarred, SaaS financial experienced SaaS finance experts, and I can hire them on a fractional basis and level up my entire company. And that also, to your earlier point about the go to market and all that kind of stuff, that would free up CEOs and CFOs to focus on the go to market side, and focus on the growth, and just trust that this outsourced team is doing their thing. And that was another thing that was always great at SaaSOptics, is often those teams use SaaSOptics internally themselves to support their own team, so they can support their multiple clients in with the SaaSOptics account. They can support multiple clients and get that level of maturity across all of their clients, which is great. So it was a very nice sort of hand in glove relationship there.
That's great. And so, one of the things you keep pointing to is this idea that SaaS is different. And so let's assume that we got people who, other than my mother, who's listening to this podcast, but like my mother, probably doesn't know what makes SaaS different. What's the core thing that people don't realize if you've been doing lawnmower as a bookkeeper and now you come over to a SaaS business? What are I can think of one in particular, but you've been in it a lot longer than I have. What one or two things that people really need to think about in terms of getting the SaaS operating metrics right? They're not GAAP, right? It's this other way of representing how you're getting, to your point, revenue and cash. What are the 2 to 3 things that people really need to think about?
So the big thing for SaaS in particular is revenue recognition. It's the revenue recognition rules are just different, right? For if you go and mow somebody's lawn and give them an invoice or let them or run their credit card, you can take all the revenue right away because you've satisfied all the rules for recognizing that revenue. If, however, I sell a contract on January 1, a SaaS contract that lasts for one year, I might invoice them that day, but I can't recognize all that revenue because I haven't delivered the entire service yet. So there's it's obviously more complicated than that, but those are generally speaking the rules there. And so just the revenue recognition rules, you can't claim all that revenue in a SaaS business until you've delivered that service. So it's a $12,000 service, let's say. You can't claim all $12,000 on January 1 because you haven't delivered the service yet. So that for those of us that have been in SaaS for a long time, that's obvious. But if you're new to it, that's not necessarily obvious, especially if you're coming from more of a traditional business. And the other thing
Yeah,
I
and I
would
think
say, oh, sorry.
sorry, just adding to that, I think that just and then the distinction between paying for the software and when you can recognize that revenue, and paying for things and recognizing the revenue for services, so statement of work services, so implementation, and then it gets complex in terms of, well, if you give people 3 months for free, but it's only a 12-month contract, how does that play out? So all of that's impacting kind of the way you represent your ARR, and the ARR growth, bookings growth, is something. That shows the future evolution of the company, and that's what investors are investing in, right? They're investing in the potential growth, and to your point, that then leads to cash. But understanding when you can recognize revenue, when you collect cash, are two different things. So keep going. You had another point in terms of SaaS that was unique to our world.
Yeah, that's absolutely correct. Everything you just said is absolutely correct. The other thing I would add too there is you can't run a SaaS business unless you know what your churn is, right? To your point, it's a non-GAAP metric, but it's a very, very critical one, right? So who's churning, what dollars, and what customers are churning, and things like that. You can't run a SaaS business without knowing that. And I'd also go one step further and say you really, really need to know the composition of your revenues. You can probably run a SaaS business if you don't know the composition of your revenues. But by that I mean new revenue, upgrade revenue, news, renewals, upgrades, downgrades. You need all that stuff to properly operate a SaaS business, and you can't find that in a financial statement. So anybody that's coming to the SaaS world from another place, maybe just accustomed to looking at balance sheets and financial and income statements. There's no place on an income statement where you can find out what your churn is. You can't even back into it. And you really can't even back into your revenue composition. You can see we grew revenues this year over last year, but you can't see it. You can't see what's renewal revenue, what's new revenue, what's any of that. You just can't see it. So you have to have metrics to run a SaaS business that just aren't available in your typical financial statements.
Yeah, just building on that a little bit, I think that one of the fundamental assumptions, and I've been in SaaS a really long time, is you spend a lot of money to acquire a customer. It's a different type of business model. People aren't buying a computer and they're paying you $2,000 for the computer. They're probably paying you lower on a per month basis that than to cover your go to market costs, your customer acquisition costs. And so understanding your churn, your lifetime value of a customer means, are you going to be able to acquire those companies and support them over time profitably? If you can't, like if your gross retention in this case is below 70%, you got a real problem. And so to your point, being able to break out gross retention versus contraction, so understanding which customer and segments are contracting, what's happening there by product, by region, by segment, allows you to, do you have a sustainable business model? So you move from, hey, product market fit to business model viability. And I think a lot of early stage founders focus on bookings growth, which then they turn into AR growth. And then you hit that next inflection point. I don't know, $3-5 million. You've been around for a little bit. You've really got to change the emphasis and focus on your customer retention. And what are the programs that you're running? And this is one of the things I think a lot of SaaS leaders, especially if you have early stage VP of sales who've never actually run the customer success motion, they overlook or don't fully appreciate, is it's not a cost center. Support's not a cost center. It's really a profit center in terms of securing and expanding your customers. Because the other piece is, to your point of, well, how much revenue is coming from expansion? If you're selling seats across divisions or seats, how many more seats can you get next year? Or features, how do you drive features in? Because you've spent so much to acquire that current customer, that first customer, you got to get the return. And it's usually like, CAC payback periods of more than 12 months is problematic, but often it can be, 2 to 3 years. And you're like, I'm not making money on this customer until 3 years after we initially signed them.
Yeah, that's a very uncomfortable feeling. But also to your point, what saves you there is your customer success crowd, right? They to your point that they hear about the gaps in the product. They know the things that aren't serving necessarily your customers as well as possible, and they know why they have those problems. And so to your point, yeah, the customer payback might take some time, but your support, your customer success crowd is the sort of This is sort of your information lifeline to how to serve those customers and make sure they stick around long enough to become for the cost to serve to go down and for their sort of their contribution overall contribution to your company to be sufficient.
Yeah, you make me think, Clayton. I think we probably have talked about this before. That there are, as you think about a business, and this may lead in. I want a couple other minutes on Office of the CFO, but this may lead into our conversation around what does it mean to be a CEO. Like, what are the metrics, the bucket of metrics? You have your finance metrics; those are dictated by GAAP. You're going to have a good accountant that's going to cover your butt on that, and you get to our conversation. Get an accountant who understands SaaS, even if they're not doing the operating metrics for you. It's just it helps for them to appreciate how you structure your reporting. Gap, you're arguing about, does customer success go above the line or below the line? Everything else is pretty much dictated for you, and you're just producing your balance sheet, your profit and loss, and your cash flow statement. So you have finance metrics. I then think you have a set of operating metrics, which we were just talking about: gross retention, net retention, LTV to CAC, magic number. I mean, we can go on forever about all the operating metrics. In fact, Ben Murray, who is the SaaS CFO, who you and I know and have great admiration for. He runs a whole course on this. I took it before I joined Maxio, in part to refresh, in part because I was like, well, I'm going to a company that espouses to have operating metrics. I better know what the heck I'm talking about. But it was great. But I mean, his dashboard, they're like 27 metrics. And so when you think about operating metrics and which ones you're going to look at and how do you set targets, and so you don't get overwhelmed, is a huge discipline in and of itself. And the third bucket of metrics, I think, are these investor metrics.
Mhm.
And investor metrics are ones which you are only really reporting on a monthly or quarterly basis when you go to the board, or if you're trying to raise money. And
Right.
as a CEO with a CFO, being able, I don't know if you would have a fourth bucket, but being able to understand the relative importance of those different metrics and the frequency at which you have to aggregate them and understand them and report on them is critical to your ability to grow a company and secure funding.
Right. Yeah, you're absolutely right. I'm not sure I have a fourth bucket there. One thing I would say though is that this is just goes. This is my bias because I saw it a lot over the years. Is a lot of people just do a metric because they read a blog post on it. Right. They don't even know why they're doing it. They know, or maybe one of their board members asked them for it. Not entirely sure what it tells them or how they should be using it. One of the things that that I think especially early stage businesses that are out for money, they go out and they get into a fundraising process and get hammered with these questions from investors and assume that they all got to do with this all the time, right? We need to know that metric at all times, every board meeting, every to go raise more money later on, everything like that. So they get into this sort of cycle of not necessarily understanding why they're doing those metrics. Now, to your point, investor metrics, that's for the investors, but operating metrics is for you to run the business, are for you to run the business, and understanding why you're doing them. Just because doing them just because you read a blog post or an investor asked about it is insufficient. It's got to tell you something about the business.
Yeah, great. I think one, I mean, I can come up with three where there's a nuance around what is the definition you're using, because there is no gap. It's kind of the wild, wild west, and everyone can
Spot
come up
on.
with their own definition. I know at SaaSOptics, while you were there, you were doing SaaSpedia, I think, and were
Mhm.
providing a lot of YouTube videos that are still available for people where you were explaining things and you had your own bugaboos that you would take on as waterfall versus roll forward, for example. But with gross retention in particular, it's one of these metrics I find interesting because I do think people will define it slightly different. Sometimes they just include loss, sometimes they include loss and contraction.
Mhm.
And so then when you're trying to set a benchmark with other companies in the portfolio for your investors, or more broadly, like when Ray Wright publishes benchmark it survey, to your point, like really understanding, okay, what's being included in this metric so that you have an apples to apples comparison. And why is it important to think about gross retention minus loss versus gross retention minus loss and contraction? And how do you want to disaggregate that?
Right.
Um, do you have one? And the other one that sort of pops for me is LTV to CAC, and how do you assume your retention rate there, and how that plays out with the formula? But is there another one that you sort of think a lot of people maybe misunderstand or misrepresent?
Um, Misrepresent, yeah, but it's usually unintentional. It's one of this is a
Right, or just
conversation,
misunderstand it. So that,
exact misunderstanding or an unintentional mistake. This
yeah,
is one I've had a conversation I've had with a dozen VCs over the years. Is they just is somebody inadvertently makes a mistake or includes something in a calculation that they shouldn't, and that kind of stuff. As
yeah,
an example, include non-recurring revenues in an ARR in an ARR calculation, stuff like that. So usually it's a mistake and unintentional, but it's the kind of thing that invites more scrutiny.
Yeah.
When you hand that over to an investor, to potential investors, that just means they're going to get a magnifying glass, and tear your books apart, right? So
Yeah.
it can often invite unwanted scrutiny that you didn't have to have, right? So and it slows, especially in a fundraising event, it slows things down. I would say the other one the other mistake I think people make is they, to your point, with the gross retention, everything like that, is they don't segment enough. Now, part of that is it's hard, right? Especially
Yeah.
in junk heal spreadsheets, segmenting your segmenting your retention, your gross retention along the lines of your customer base is tough. So one of the things that we kind of got right, again, we didn't get everything right. So one of the things we got right at SaaSOptics is we had some pretty easy cohort reports that would allow you segment your customer base pretty easily. And gross retention is not created equal. It's another frustration I've heard from VCs over the years is they'll look at this, they'll see a business with an alarming retention rate or churn rate, and then they ask the prospect, their potential investee, to segment it for them so they can get a better, closer look at it. And it turns out there's only one segment of their customer base that churns at a high rate. Everything else looks okay. But blended all together, it looks like a mess, and it would be enough to send any investor running for the hills. So I'd say it's another thing that I would say another mistake I see fairly frequently is people just don't segment enough. Part of
Yeah.
it partly because it's hard.
Right, and getting the data and sorting it and doing all the pivot tables on it. And I do
Exactly.
I rattle it off probably too quickly, but being able to understand your metrics by product, by segment, and then by region when you go
Yes.
multinational is wicked important because to your
Yes.
point, your SMBs are probably gonna churn faster, but what's the trend? And be able to show trend over time, and then you can benchmark that, and that's to be
Spot on.
different similar with CAC. What do you so for example, we have a
Right.
BDR construct for our early stage segment, what we call startup and SMB. We don't have BDRs because it's an extra cost and we can't afford it at the price we're charging. And so then you're able to bring investment decisions and structure around go to market, customer success teams by segment. And so you get to the unit cost economics of customer profitability, which I think is one of those things that is this combination of what you're getting out of your financial statements, but it's also this depth per unit cost of customer that then you roll up by product, by region, by segment that allows you to understand, are you running profitable units, right? Business
Yes.
units. And that's important at
Yes.
companies that are, 1,000 customers, as much as is important when I was at Microsoft and Salesforce. We did hundreds of thousands of customers.
Right.
Getting that unit cost economics is critical.
Absolutely right. And especially if you're out for funding,
Yeah.
being able to have that conversation with a potential investor is
Yeah.
massive. And
Yeah.
also helps you stand out. Funding is a fairly competitive process, as you know. It also helps you stand out from the other people that might be seeking funding too. It's like, wow, this bunch really knows what they're talking about,
They
and
have their
knows it
stuff
to
all in one stock.
exactly right.
Awesome. Well, good. Well, hey, given the time, why don't we go to what makes a great CEO? I've been a great admirer of you, and you've got just this special energy and magic. I've been writing on the 7 secrets of success for CEOs. I've now added an eighth because I've gotten beaten down by the people on this podcast. But the seven include, and then we can talk about which ones really you find are the most important in your own experience, having been multiple time founder. Number one is overall results. This is about delivering shareholder value, especially for someone like me who comes in as a professional CEO behind VC or PE money, right? Other people that put money on the deck, you've got to deliver the results. To inform that, number two is about establishing a winning strategy so everyone knows what business you're in and what you're not in. I think early stage companies, it's easy to kind of spray and pray and hope something hits. So having a winning strategy.
Right.
Number three, which I know you have a lot of a passion around, is shaping the culture, the vultures, the values and standards that will guide your company over time. Number four is building an effective executive team. So taking a group of people that are functional leaders and make them part of the first team. Number five is managing your board and investors. So we've been talking a lot about that, setting the right kind of expectations. Number six is allocating capital to balance the yield today with the necessary investments in tomorrow. So, how do you do Horizon 1 versus Horizon 2, Horizon 3? Number seven is investing in you. So, making sure you have a mentor, a coach, a peer group. And then number eight is unlocking the potential of your team. How do you make sure that you're growing your own and you're helping people have extraordinary experiences? So, that's a word salad. Lots of topics there. Which ones resonate for you? You'd like to kind of provide some insight on?
So the one that I love all of them. First of all, and I think they're all required. I think that they are all critical to get to eventually. Maybe not day one, obviously, but as
Right.
you evolve, they get there. I would say the one that jumps out a lot is two that really jump out. One is the team. One of the things that that my co-founder and I talk about a lot is we didn't get everything right, obviously, but one of the things we got really right at SaaSOptics was the team. It was an amazing team. Give me another team like that, and I'll take over the world. It was absolutely amazing. They were incredible from day one.
And
From the
sorry,
time we
so is this your executive team or broadly every hire you had? Or I mean, that's a broad statement to say everybody we hired was great and we would take over the world. Or is there a way that you focused on, maybe start with the executive team, the
Yeah,
people that you hired for that early stage, your first set of senior executives? How did you
right.
think about that, and how did you ensure you got great people?
It's one of the things we got this pretty right. And to your point, yeah, that was being overly broad. Yeah, one of the things we hired for, especially in the early days, we really had two attributes. We want people that have a high level of integrity and work really hard. Those are really the two attributes we hired for in the early days. As an example, this will be close to your heart. Our very first sales rep had an English degree from the Naval Academy.
There you
you
go.
know, exactly right. On paper, you wouldn't, anybody who was hiring for a sales rep, an experienced sales rep, wouldn't have
Yeah,
hired this guy, but he turned out to be
yeah,
amazing. He was incredible.
yeah.
And so we kind of had that. Our first sort of director of customer success had a theology degree. Again, on paper, you would look at that person and go, I'm not sure this is the right fit. But these were really great hires because, again, high level of integrity and work really hard. And they became leaders in the company because they were early hires and things like that. And once we started hiring behind them, people sort of naturally looked at them as the leaders, as the sort of old guard that kind of embodied the culture and embodied, the sort of the way we thought about things. So I wouldn't say it's easy because hiring is never easy, but what it became, building a really good team became easier after those initial hires were in place because they kind of embodied the way we thought about things and the way we went about
And the
hiring.
values and the standards. So more about the how versus the what. One of the things we've codified at Maxio is what we call the Great Leader Framework, and it's all
Mhm.
about capabilities, not specific skills in terms of I can run a red account program.
Right.
One of the things I've been struck by and why I took the job, Clayton, was because it felt like the culture at SaaSOptics, Maxio, and Chargify was different than a lot of the Silicon Valley companies I had been part of. Like people were just nicer. So what struck me is you said high integrity, worked hard, but you didn't include two other things. Silicon Valley, I think, over indexes on IQ. And
Mhm.
then you also didn't mention this idea of just being a nice person. How did you kind of filter for that? Because the culture is really, in my opinion, unique in that way that people are collaborative, they're kind, they're not out to get each other, it's not a zero sum gain. It feels really different, and that must have been something that you guys uh, embraced and articulated and hired for early on.
That's exactly right. Yeah, we had a sort of it's a good point. It was never really sort of, I wouldn't say we ever put it on a job description anywhere, but we had a kind of a no jerks
Yeah,
policy there. We just,
yeah,
if you're, and we also, we interviewed pretty strongly. We'd have most everybody that we ever hired at SaaSOptics went through at least three interviews, right?
right,
So sooner or later, if you are a jerk or you can't control your emotional reactions to something as simple as an interview, then you're not going to get hired because what happens when a customer calls up is a little bit angry because they found a bug in the software. If you can't
right.
control your emotional reaction in an interview, and there's no chance you can with a hostile customer or a frustrated customer, right?
Yeah.
So I'd say we kind of sort of naturally weeded those things out in a pretty tough interview process over the years.
Got it. And did you use a lot of back channel references, or was it friends of friends? Because I think that's another thing is someone's at a company, what you hope for is employee referrals. Because if they're doing well, they're going to, birds of a feather flock together, right?
Right.
They would
Right.
have a set of friends that you would want to bring across. Was that another watering hole you fished in?
Well, absolutely, relentlessly. One of the sales rep I mentioned, the Naval Academy grad,
Yeah.
he went to a small high school there in Roswell, and before you know it, we had hired almost all of his friends that he graduated with. Some that graduated a year before, and some that graduated a couple of years after him. They were all still really tight, and they were all same. So to your point, birds of a feather. They were all great guys, and we hired him pretty relentlessly after that, and still in touch with quite a few of those guys, even after all this
Oh, that's
time.
great.
Yeah.
Yeah, I talk about software being a people business, and it's those
Yes.
relationships that are rooted in trust. Trust is tied to having high integrity and having a common sense for what it means to work hard,
Spot on.
and expectations for,
Yeah.
it's not a job, it's like it's a vocation. Okay, well, we probably have time for one more of the 8 secrets. We talked
Mhm.
about really hiring a team and helping that team and the cultures and values. Is there another one that sort of pops for you with your wisdom now, looking back on the most important things CEOs need to get right?
There's one other one that you listed, and I would call it. It was allocating capital. It's
Right.
interesting how it's. I think it's a critical skill, but a lot of CEOs, especially CEOs that came from the sales and the product side and founded their own thing, have very little experience with actually allocating capital. They're I was a product guy or a sales guy, right? And I started this business, and we're getting a little bit of success now, but they often struggle to allocate capital, and I think finance can sometimes be a bit of a doesn't have to be, but it can be some kind of a bit of a mysterious and spooky thing for somebody that's come from the product side to try now all of a sudden to be allocating capital across the entire business. I think it feels a bit uncomfortable to some people. So I think it's a critical thing to be doing, especially at the stage that Maxio is right now. Allocating capital, and even before, allocating capital is a massively important thing, and a lot of CEOs just are inexperienced with it.
Yeah, I do feel fortunate. I mean, people give you grief for getting an MBA, but I do feel fortunate coming out of the military, having the opportunity to go to an MBA, learn the language of finance, which is accounting, having the opportunity to take a class in finance and learning how people thought about capital structure and investments. And it was a skill I had to build.
Mhm.
And then what's interesting is, you go through your early part of your career, you're probably in as a director, you're not really spending a lot of your time thinking about finance and capital. I actually went back and took another course, finance for non-finance executives, when I was
Mhm.
CEO. In between two CEO gigs, I felt like, gosh, I had done this 20 years ago at business school, but it's been a long time. I need to go refresh. So I
Yeah.
think, to your point, people, CEOs, getting strong CFOs who are thought partners in helping to think about capital structure and investment. That's a critical role of the CFO. But
Correct.
also, I think the CEOs, knowing that what they're doing is playing with other people's money. And so they got to be able to think about ROI, NPV, making business cases, how things are going to play out, what are expectations for things you're making bets on in 18 to 24 months, instead of just solving for what I need to get done today. Because you're never going to
Right.
get to the next act if you haven't placed some bets and are letting things play out a little bit.
Spot on. I agree with all of that. I love that. I'd also say there's one thing that's not on your list, and this is very much my bias,
Uh-huh.
but I saw it, a lot in the early days, in early stage companies. Early stage CEOs. This is 100% my opinion. Early stage CEOs, I think, need to be more like COOs than CEOs because
What do you
a
mean
lot
by
of
that?
them. Well, a lot of them. A lot of the conversation I heard over the years is well, my job is to set the vision and to blah blah
Right.
blah blah, right? And sort of they kind of extracted themselves from the day to day nuts and bolts. And I think in early stage business that's a mistake.
Yeah.
Because the nuts and bolts are where it's at in the early days. When you're incubating and trying to get to the next stage, you're never going to get to the set the vision stage if you can't get past a million in ARR. And when
Right.
you're at a million in ARR, you're getting some things right. And the CEO needs to know at a very very low level of detail what's going on in the business. And if they sort of if they have the sort of ivory tower view of a CEO, kind of sits on high and direct and does this and twists some buttons and everything like that, then I think it's a mistake. And I saw a lot of that in the early days. So
I think that's a good build out of the first one I described. The number one thing you're responsible for is overall results, and that does mean, like, you've got to be in a level of detail and set up systems so you can monitor what's happening. I mean, that's the
yes,
advertisement for Maxio is you get access to information that you as a CEO are able to inspect. You're not relying on other people, but it's also, how do you set up a rhythm of the business? How do you do you get what you inspect, right? So what are
yep,
the ways you do it without over functioning and micromanaging? There's that balance, but you are the dude that the investors invested in,
yep,
or dudette, and you've got to be able to deliver it. And if you don't know it, you're going to get removed.
exactly right, 100%. I couldn't agree more.
All right. Well, now we're sort of wrapping up. We talked a lot about, the speed round. I usually have 3 questions. What's your favorite metric? What's your favorite book? And who's your favorite influencer? We talked a lot about metrics, but is there one that we didn't address that you think is critical for people to really keep their eyes on?
Yeah, this one is certainly again my bias. It's sort of my golden goose is customer lifetime value, and the reason for that is to do a proper customer lifetime value to get that proper customer lifetime value metric. You have to get a lot of this other stuff right too. You need to know your cost of capital, you need to know your retention, you need, all that kind of rolls up into the customer lifetime value calculation. So it's a bit of a cheat because you have to get some other stuff right to get
Right.
CLV. But I think CLV is critical. I mean, who doesn't want to know what a customer is worth to them, and
Right.
especially segment it from there, right? Every business in the world should know that, and or should
Yep.
want to know that. And so
Yeah.
that's definitely my favorite. It's certainly my bias, but definitely my favorite.
That's a great one. And then I think you start to think about if there are three ways to grow a business: acquire new customers, retain current customers. You have this other idea of monetizing the customers you have with pricing and
Spot on.
packaging, and so customer lifetime value. How do you maximize it over time?
Yes.
Book. What's your favorite book, or what are you reading right now?
I'm reading right now. It's an investment book, but my favorite sort of business book that I've read in the last 10 years or so is "The Hard Thing About Hard Things" by Ben
Yeah.
Horowitz. I
Yeah.
love that
Absolutely.
book. Yeah,
Yeah. I think any CEO, aspiring CEO, should read that, and in your darkest moments, pull it back out and go back and look at your notes, because you
that's
know what?
right.
It's hard.
It is hard. It is hard. I agree with that 100%. It should be on every CEO's shelf 100%. Yeah.
And then finally, influencers, people that you're listening to, watching, or reading that you think are actually saying new and interesting things versus just repeating the echo chamber.
So, so this is a recent acquaintance is a CEO named Maya Mikhailov. She's
Uh-huh.
CEO of Savvy AI, and she's
Okay.
so I freely admit I've explicitly ignored a lot of the hype around AI because it felt just like a hype cycle thing to me. So I
Uh-huh.
explicitly kind of ignored it. It's a little too reminiscent of the .com boom
Right.
back in the day for me to
Yeah.
get super intrigued by it. But that's one of the reasons that I like. I've been reading Maya's stuff is because she posts a lot on LinkedIn. And she's got a very sort of clear-eyed perspective on what AI is, and I've really enjoyed reading her stuff. So I'd say that she's the most recent influencer for me.
Got it. And sorry, it was Savvy AI
Savvy
is
AI, yes, is
all
the
right.
name of the business. Yeah,
Well, maybe we'll try to put that in the show notes. I'm always looking for people to learn more about and learn
yeah,
from. So
yeah,
it's great, Clayton. It's
yeah.
always a pleasure chatting. Thanks for spending a little time with us, talking about where you've been, what you learned, and how CEOs can think about being successful.
Likewise, man. It's been great talking to you, and I'll talk to you later.